What's up, you guys? It's Daniel here, and it's actually been a while because I haven't done anything in a long time, but it's April. We're at the end of April actually, and every year, not every year, but the last 3 years, I started investing in stocks ETFs. And I do this because I just want to keep up posting every year so that I can look back and see what I've done and what I've learned and what I've made. So we just have to jump into my portfolio this year and the past year, and I'll show you what's changed. So the first thing I'll say that's changed is that I actually got a notebook because I've changed a lot of things. So I've actually just jumped into buying whatever and without knowing anything about the company. I just thought, all right, I'll just buy this company. Like, oh, Tesla is fantastic, I'll just buy that, without knowing anything about their financial statements or anything at all actually. So this year, since January, I've actually been looking up financial statements at thousands of numbers, and it is crazy. So in here I have all the numbers, basically all the companies that I like and don't like. So I have all the companies that I invested in the past. So you'll see last year that there are a few companies that are on the list last year that I've taken off. Even though they had profits, I still took them off because that I didn't like the numbers. So what actually is, this is just my thing, what I do. You shouldn't do what I do, so do your own due diligence. You have to learn and well, figure out what works for you. So this probably wouldn't work for you, but this is just what I do, what I like. So if we take Coca-Cola, for example, a company that I like, they don't have like, it doesn't go up like 40% tomorrow and then down 30% in next week. So this is a company that has been around for a long time. It's probably going to be around for a long time. They have a really unique selling point. And what I like is that I looked into their financial statements. So I look back 4 years here. And one thing that I like to see is that I like, in all the companies, I like a gross margin to be over 40%. A net margin is also something that I want to be above 20%. I want them to have a great return on equity as well. So make sure that they pay back. And also, if you look at what they own, what they hold, you want that to be strong as well. And so when you look at, what's that called, capital expenditure to net income, you want that to be less than 25%, except if they're growing. So if this company is looking to expand massively, so if you look at Apple, for example, so they're growing, so their capital expenditure to net income might be a bit high, so it can be like 50%, but no more than 50%. That's because they're growing the company, so you actually have to look into what they're spending money on. But from a Coca-Cola that have been around since the late 1800s, so you want their capital expenditure to net income to be quite low, less than 25%. So the past 4 years, it's been from 20 to 15. So it's a company that I really like. I really like adding onto that, adding more into that all the time. It's something I believe in. It's not gonna give you 10% a year. It's not gonna give you 20%, but it will probably give you about 5% a year. And if you keep that for 40 years or even just 10 years, it's fantastic. I'm not calculating whatever that is. So that's something I just wanted to go into. So that's why I've sold a lot of companies like Lloyds Bank, AT&T is just what I can remember right now. They did give me, that both of them had over 10% return, about the 20, something like that. But I did sell them off because of the financial statements that I looked at, and they didn't hit the figures that I like. They can still be great companies to get into. They're giving great returns, so it could be fantastic. It's just not for me. All right, so if we jump into, so I'll take my portfolio here and I will pop that on the screen right there. And so last year, because almost all September, usually stocks fall a little bit, And I thought, well, this is fantastic. I didn't know what to do with a bit of my cash, so I thought I'll put a few thousand into stocks and we'll just see where it goes. And then in October, the whole thing just crashed. Without me knowing any numbers, I didn't have that book. I didn't study any figures or anything, so I even put £1,000 into Tesla, which fell over 40%, which is just insane. But so £1,000 in, but you can now today get back £600. So that is a horrible investment. You always want to keep a look at the PE ratio, so purchase to earning ratio, which is something that I look at as well. If it goes above 40, I wouldn't buy it. That's when I'm selling, because how long will this stay above 40? So that's why I'm selling off. And for example, you look at Tesla, which was 60-80 purchase to earning ratio, right? And I didn't know that back then. I've learned all those mistakes. I've learned so much. Why didn't I learn it before? I have no idea. But it's something that you should learn. Learn all this before ever putting a pound in is something I would recommend. You could also set up, so I use Trading 2 and 2. There's a link in the description that you can click onto and you can get a free stock over £100. And if you do that, you can let me know what you get. But I would go into practice. So you can go into practice mode, so you get £50,000 or something ridiculous. Do that for a year. This is something I recommend, because you can't really lose fake money. Well, you can, but you won't lose. You lose time. You'll probably lose a few hours. Do that maybe for a year. Try and test and play around with that and learn everything there is to learn. Learn from my mistakes so you won't make them yourself. This is not financial advice. Alright, so what we can see, well, you got my screen here on there, so it's the same thing. Everything that I've put in now so far is £10,165 and 16 cents. Pence. We're not in the US. And it's worth now, so if I sold everything, I would get £9,358 and 42 cents. Pence. Keep saying cents. Which is not great. So my whole portfolio is down almost 8%. If we press my finger on here, you can see that it has gone down a whopping 10%. At some point I think it was a bit more, so 11% almost. So it went down 12%, which is horrifying to watch. So investing can be really scary. You just need to remember it's for the long run. I've been here for 3 years now and I'm on minus. Why? That's because I didn't know what I was doing. The past 3 years, it's just been gambling. Actually, it's just been gambling because I haven't looked at anything. But I believe the next 5 years, well, my goal was to keep doing this 10 years actually. So basically just 10 YouTube videos, and there'll be a profit on them, which there is no doubt. So if I keep just looking at the financial statements and just keeping up with that quarterly, figuring out what's going on, I'll be well off. So this is not passive income because you have to work for it. You have to look at statements and stuff like that, which can be tough. Loads of numbers to look at, and it's so difficult because every company has a different word for a different thing. So that's ridiculous. Activision Blizzard is something that I really like. Their PE ratio is over 40, so I haven't sold that off. And the reason for that is because the numbers are fantastic, and because Microsoft has invested. Did they buy it or did they just invest heavily in it? I think they bought it, right? That's why I'm actually keeping that. But if the PE ratio goes way up, I'll probably sell it off and then just wait for the PE ratio to come down and then buy back in, or just leave it alone. You'll see a lot of my stocks are minus, like we got Air France minus almost 60%. Why haven't I sold that one off where the PE ratio is actually 0? So what is the company actually worth? All the numbers are horrible. Everything is not the best. Why am I keeping that? Because I just don't want to sell it. There's no point for me selling it. It could go down 100%, so basically 40 more percent. So I'll just leave that alone. Let's figure out what happens in 6 years from now. So I'll just leave that alone. If it comes back to zero, or if it will be like 1% profit, I'll probably sell that off. So as soon as all these companies, all these shoe companies, I have 3 shoe companies, it's something that I should sell off. They don't hit the figures that I wish that they would. So it's something I should sell off. Yeah, just stop with that. One thing I found funny as well is that we got here Alphabet, which is Google, but you see the G. Oh yeah, so it's only 12 o'clock. So all the EU, so Alphabet in Germany is open, but everything in the US isn't open yet. But that's fine. This is just a video year on year. And why Alphabet in Europe is minus, or Germany, and in the US it's plus, I have no idea. I'm keeping that because the numbers are good. But why? It's the same company, so why not? I don't understand that at all. Amazon is something that was way up and then it just crashed down, which is, again, the numbers are not where I would want them to be, just because they're investing so heavily on growing that they're, if I remember correctly, they're past their 50% expenditure compared to net income. So it's something that I would sell if it comes back to zero. Not likely to happen right now, in this year or next year. Probably next year. I'll look back. Is it still zero, Daniel? But we got Apple, we got Coca-Cola, which are doing fantastic. I bought at the worst time, which was everything fell in September 2022, and then we hit October and it just fell further. And I just bought just before everything fell down. In January, everything came back up. So if I had bought in December, the whole portfolio would have been plus. But it doesn't matter. The only thing I could have done differently, instead of just taking like £6,000 and bam, crashing into the market, if I would have put in 500 a week, just 500, 500, 500, 500, my whole portfolio would look completely different. So I try now to put £100 a week, which I haven't done in the past 3 weeks. I'll try to put in just a little bit week on week. It could be just £50 a week. But Apple, Coca-Cola, McDonald's, and the S&P 500 is my favorites. Microsoft is also one of my favorites. So, but I like to have a spread out portfolio, but just Apple, Microsoft, and Google, and Activation Blizzard, which is kind of like owned by Microsoft. Those are 4 tech companies. So I like to spread out the industry a little bit. So it's like tech companies, food companies, and other companies, right? Where I have 2 food companies and 4 tech companies. It's not super well diversified. And S&P 500, of course, which is super diversified. They're really heavily into tech companies. But yeah. And here you see something that is strange. It's Skechers. I just said I have 3 shoe companies, Nike, Adidas, and Skechers. They don't hit the figures that I would like. So why not just sell off Skechers? I don't know. I think Skechers is just a gamble for me. So I could sell it now and get £80. It's just gambling. I think Skechers is just something I'm gambling on, and if it hits £100, I'll probably just sell it off. It's not something, I'm not putting more into that. Just leave it alone. A little treat. We got Tesla. Like I said, I put £1,000 into Tesla, and if I sell it today, I get £670 back. Almost. There's a bit less than that. So we're not putting more into that. Just leaving that alone. If it hits back zero, because I think it lost because Tesla didn't hit demands. So if you want a Tesla, there's just a massive waiting list, and they're just not delivering, which is horrible. But maybe they can get to deliver more cars, and it'll come back up to zero or even past zero, which would be fantastic. Then I'll just look at the numbers for next year, or look at the quarterly financial statements. If they're looking great, then I can maybe put more money in. But as for now, I'm not putting more money in. The Vanguard, I am putting more money in all the time, just because it's something that will grow, but it's not going to shoot up, it's not going to shoot down. We got 500 different companies, most of them tech companies actually, so I'll just put a little bit here and there money into that and just leave it with that. I consider this my pension, so my first goal is to leave it for 10 years. If the whole portfolio is 2% up after 10 years, I might just take everything out and put it elsewhere and do something else. Time will show. So time will tell. So let's see what happens after 10 years. Everything else, it's basically just losing. All these numbers, it's just companies like Disney owns so many things. I thought Disney will be a sure thing. If you look back at previous videos, I said Disney is something that I believe in, and it is something I believe in. Same with Volkswagen Group. What doesn't Volkswagen Group? They have all the good cars like that, or they have so many car companies. They have Volkswagen, of course, which is huge. They got Lambos, which they're super cool, right? And they got so many different companies. I wouldn't even. So they got so many luxury brands though. Like they got Lambo, Bentley, Porsche. Do they own the Rolls Royce? I don't. No. I don't think so. Because Rolls Royce is the same as planes, right? But they got many luxury brands, and they got other like normal brands. So why wouldn't they do well? Looked at the numbers, the figures. They're not doing that great. They're not hitting. They're doing great. They're fantastic. They're a $1 billion company, which is cool. They're just not hitting my figures. So again, I'm not putting more into that. I'm just leaving it alone. It's a minus. Leave it at minus. If it comes back to zero, take that money out and put it into a different company, food companies, or some McDonald's, Coca-Cola, Apple, Microsoft, or even just the S&P is something that I would be looking into. So all these minus companies, as soon as they hit plus, the money will go elsewhere. So come back out and go elsewhere. So I'm looking to have, instead of having 20 different companies, I would prefer to have max 10 companies, maybe 7. It's also quite difficult because you have to, if you have 20 companies and you have to look at quarterly statements for all of those companies, it's almost a full-time job. So I want to make this as passive as possible. This is not passive income because you have to look at quarterly statements or annual statements. Quarterly statements is probably better because after you get the annual statements, it might already have changed, gone up or down. So yeah, quarterly statements is probably the best, but for 20 companies, it's basically a full-time job. So rather, my opinion, I would rather keep it, try and get it down to 10 or 20 or 10 or 7, just to make it easier for myself or more simple. That's my portfolio for this year. Anything else I can say? I'm not sure. If we go back 1 year, I don't know why I didn't do this earlier. We'll go down back 1 year. You can see that in September, when everything went down, I was like, perfect, everything is going down, we're at the end of September. So I put in £6,000 almost, and the whole thing just plummeted. So in September I was at minus 5%, which I just kept it at that, put in another 6, and the whole thing just went down. Crazy. 12%, 13, 16. Look at this. The whole portfolio was down 17, almost 18%, which is super scary. You just feel like selling the whole thing off. But that's not the whole point. We're keeping this for the long term. So just leave it, keep it, leave it, put in, instead of doing heavy investing like I do, I did back then, my mistake, read financial statements and then put in gradually, just a little by little. That's it for this year. Yeah, and just see you next year.